This section is on the classification of accounts. In accounting, it's very important that we understand what the different types of accounts are that we work with. We need this in order to solve the accounting equation. We needed to do journal entries, we needed to do general ledger entries, and ultimately we needed to draw up an income statement and a balance sheet, which are the final financial statements of the business. So in this section, we're going to look at the different types of accounts that we get, and you can compare them with what you have in your own house. So let's look at the first one. Assets. Assets is anything that the business owns. In your own situation, you might have a house that you own, you might have a vehicle in the garage that you own, and you might have furniture inside your house that you own. The fact that you did not buy all of these items cash does not matter. The fact that you bought them and that they belong to you makes them assets to you. On the other hand, the money that you now owe, because you had to borrow money to buy the house or the car or the furniture, those are classified as liabilities. In other words, liabilities is anything that the business owes. Any money that is owed to another party that is used to buy assets that can be used in the business. Those are all classified as liabilities. The third type of account is owner's equity. Owner's equity is that which belongs to the owners of the business. So let's just stand still at this concept a bit. When we talk about owner's equity, effectively what happens is that the business borrows the money from the owner. In other words, the business owes the owner the equity or the capital that the owner puts into the business. Remember that we look at the books of the business from the business's point of view, not from the owner's point of view. So when the owner puts capital into the business, this means that effectively the business owes the owners that money, because at some stage the owners will want their money back. So from here we can then see that liabilities and owner's equity will be classified as the same kind of thing, whereas assets is totally on the opposite side. This concept is important when we get to the accounting equation, which is something that we'll do in the next session. Okay, so let's have a look at these different types of assets in a bit more detail. Assets. We have different kinds of assets, and the first one that we're going to look at is current assets. Current assets are items that can be converted into cash within 1 year. In other words, things that are pretty liquid, things that you can sell off pretty easily and that you can then convert into cash quite readily. Examples of current assets would be debtors, or the new name for it would be accounts receivable, because we still need to receive the money from the people who we sold to on credit. Bank, if the bank has a positive balance, in other words, if there is actually money in the bank, then that is a current asset for the business. Cash and cash equivalents, a lot of time the business will keep cash on its premises, maybe in the form of petty cash, and those are also an asset to the business. And stock or inventory. Any inventory or stocks that is in the warehouse is a current asset to the company, because those can be sold off and therefore converted into cash within a pretty short period of time. The other type of asset that we get is non-current assets. Sometimes also called fixed assets, because they have a lifespan of more than 1 year. In other words, these are assets that will last us for a long time and that we buy with the view to keeping them for quite a long period of time. In your own household, that would be things like your house and your car and your furniture. Those are all fixed assets or non-current assets. Okay, in the case of the business, examples of this would be land and buildings, vehicles, equipment, and any investments that they make on which they can earn interest. Normally investments are made for a period of 1 year or longer, and that's why they are seen as fixed or non-current assets. Then we move on to liabilities. So liabilities, there's also two types of liabilities. The first type is what we call current liabilities, same as with current assets. These are a short-term liability. In other words, it means it is obligations that are payable within 1 year. Short-term stuff that the company needs to pay in your own household, that could possibly be your clothing accounts that you have with Acres, your municipal account that needs to be paid monthly, and that kind of thing. So any obligation payable within 1 year would be classified as current liability. In the case of the business, examples of these would be creditors. In other words, people who we owe money to, from who we bought supplies, raw materials, stock, anything like that. It's also called accounts payable because we still have to pay those accounts. We have gotten the goods from them on credit and we haven't paid them yet, and that's why the new name is accounts payable. Then if the bank is in overdraft, in other words, if we don't actually have cash in the bank, but the bank has made an amount of money available to us for short-term use, in other words, on a month-to-month basis nearly, then we have a bank overdraft, but it means that we owe the bank that money, and it therefore is classified as a current liability. A third example of current liability is a short-term loan. These are loans that are paid back within 1 year. So when you get a loan, let's say for 12,000 Rand, you need to possibly pay back 1,000 Rand every month, plus whatever interest you then need to pay on that loan as well. But short-term meaning within 1 year. The other type of liability, therefore, is non-current liability. Just like we had non-current assets, we also have non-current liabilities. These are payable over a period of more than 1 year. So these are your longer type debts in your own household. That would probably be your house and your car. And similarly for the business, it would be a bond that they have over the property where they do their business from, or a long-term loan, or they could even have hire purchase agreements as well for their vehicles. So these are all examples of non-current liabilities. Non-current, then your more lengthy type debt, and payable over a period of more than 1 year. Right, so that covers assets and liabilities. Both of them can be classified into either current or non-current, where current is shorter than 1 year and non-current is longer than 1 year. So now we move on to the third category, or the third type, and that is called owner's equity. Owner's equity is interesting because the terminology will differ depending on what business you're working with. We will mostly focus on your smaller type businesses and your companies. Part of owner's equity, the predominant part is called capital, or in a company it would be called shareholders' capital or shareholders' equity. Capital is the amount of money that the owner puts into the business to start it up with or to expand it. So it's not just paid at the beginning when the business opens, it can also be added later on as the owner feels that there needs to be more money in the business in order to expand the operations or diversify, or for whatever reason they feel they need more capital. Again, it's important to realize that the capital belongs to the owners, and the owner in the business is two different entities. So effectively the capital, because it belongs to the owner, is, you can nearly say then, borrowed from the owner by the business. So this capital is owed to the owner by the business. The business has the use of the money until the owner wants it back, or until the owner closes the business and then gets his money back. It's important to also just look at what capital can consist of, because it's not always money. Sometimes an owner would put a vehicle into the business as part of his capital contribution, or any other asset. So at the end of the day, the capital that the owner puts in is a value, and it's not always necessarily physical money or physical cash that gets put in, but it can be any form of asset. During the operations of the business, sometimes it might be necessary, or the owner might want to withdraw some money from the business for his own use. We call these withdrawals drawings, and they get shown in the owner's equity section as a deduction from the capital amount, meaning that whatever the owner has put into the business is reduced by whatever amount he takes out as the business is in operation. So it's also important here to understand that the owner can take money or cash or stock out of the business. He can perhaps take his vehicle back again at some stage that he put in, and so forth. So there's different options, but what is important is that if any drawings took place, then that amount needs to be deducted from the capital amount in order to give you the owner's equity balance. The third thing that is important to remember regarding owner's equity is that any profit that is made in the organization belongs to the owner. So at the end of the year or financial period, accounting period, when we determine whether the company has made a profit or a loss, and if it has made a profit, then that profit also belongs to the owners and gets added to the capital amount in order to form owner's equity. Obviously, the same would be true for a loss. If there was a loss, then the value of the owner's capital reduces by that amount because effectively he is then out of pocket. So how do we determine net profit? We're going to look at these in a bit more detail, but it just means that we look at our income and we look at our expenses and we deduct the two from each other, and what is left is called net profit. So whatever incomes the business had during the financial period, minus any expenses that was paid by the business, whatever is left over, that can be seen as net profit. This section also refers to financial statements. And I think at this point it's important for us to just have a look back and say we have seen that there are assets in a business, we have seen that there are liabilities in a business, and we've seen that there is owner's equity in a business. Those three items also will show in one of our financial statements, and that statement is called the balance sheet, which we'll do in a separate section. Similarly, the net profit that is part of your owner's equity is also represented in a financial statement, and that financial statement is the income statement. So the income statement will determine the net profit or loss that was made by the company for the financial period, and the result there would be incorporated into the balance sheet. But this we will look at in a further section. So let's just look at incomes and expenses for a bit. So net profit, we said, is income minus expenses. In terms of income, income is regarded as receipts by the business for its normal operations. Examples of this would be sales, rent that you receive, possibly on a building that you own that you rent out, maybe part of the space or office space or so on, and interest that you receive on your investments that you have made. On the opposite side, we have expenses, and expenses are amounts that is spent by the business during its normal operations, day-to-day expenses that needs to be paid, and examples of these would be the rent that they pay, the salaries and wages they pay the staff, possibly advertising, telephone, water and electricity, and all of these sort of normal things that you would also pay out of your budget on a monthly basis. So that is the distinction between income and expenses, and as I said, this will then be shown in your income statement, which we'll get to at a later stage. So just to summarize then, all of these categories can be summarized in the form of the accounting equation, where assets would equal the sum of liabilities and owner's equity. Why do we throw liabilities and owner's equity together? Because remember, both of those are categories of money that is owed to a third party. And on the other side of the equation, we have assets, which is money or items that is owned by the business. So these two sides need to equal each other. Okay, that is it for classification of accounts. I hope you understand that a little bit better now.